we're going to start talking about managerial accounting. This is going to be an overview video of some concepts that we're going to be using for the rest of the semester. When we look at managerial accounting, it is one of the components that we have to look at in making decisions. One CEO of one company has stated that a successful business is like a three-legged stool. And what he stated is that it takes knowledge and commitment to make a great product. It takes the ability to sell your product. So, that's that marketing side. And then it takes things you don't think about, which are behind the scenes, which is the accounting side of things. So if you're looking at wanting to start a business, if you're looking at running a business, these are the things that you have to have in order to successfully have a successful business. His statement was, no matter how good your product is, and no matter how many units you sell, if you don't have a firm grip on your numbers, you are up the creek without a paddle. And so that was his take on being able to look at these numbers and see these numbers and move forward with these, with making your decisions that you need to make in your company. Now, I want to look at first managerial versus financial, because up until this point, we have only been discussing financial accounting, and we're going to switch gears. With financial accounting, our primary users were external. They were stockholders, creditors, different regulators. With managerial accounting, we are looking at internal users. These are the officers and the managers of the company. The types of reports that were generally done underneath financial accounting were those financial statements, and we can compare those quarterly, annually. For managerial accounting, we're looking at internal reports, and these are prepared as frequently as we need them. Financial accounting had a purpose they were just a general purpose, and it was just for the greater good in a way, whereas managerial accounting has a very specific purpose, and these reports are done for specific decisions. With financial accounting, the content of the reports, we had to follow GAAP. It was a double entry accounting system. We had our cost data and everything that we were looking at. With managerial accounting, it is very, very detailed. It pertains to the subunits of a business, and it does extend beyond that double entry accounting. You have to really look and see what is relevant to the decisions that you are going to be making. And then with financial accounting, we did have a verification process, and that was the audit that was done by an independent CPA. With managerial accounting, there are no independent audits. There's nothing that we're looking at with that. Now, with management, and this is what we're looking at with managerial accounting, is we are trying to put stuff out there that our managers can use. And the manager's activities and responsibilities are going to be classified into three basic functions. And that first function is planning. And planning requires managers really to look ahead. It wants them to establish objectives. These can be as simple as maximizing short-term profits and market share. It could be maintaining a commitment to environmental protection, contributing to social programs. All of those type of things are part of that planning feature. Then the next one is directing. With directing, it really involves coordinating a company's activities as well as their human resources to produce a smooth running operation. So we've taken what we've planned, now we're trying to put all of that into action, is really what we're doing with directing. And then the third management function is controlling. This is the process of keeping the company's activities on track So we look and see what we planned, we look and see what actually has happened, and we make adjustments as necessary. And so that's really that major function of controlling. The other thing I want to look at with this chapter is that organizational structure. You will see this again and again in different classes, introduction to business, management, possibly even some of your stuff with marketing. You will see some of these organizational structures. The organizational structure starts with the stockholders. Remember, those are the owners of the company, and they meet once a year, and they can come in and they can vote on a board of directors. The board of directors is like the overseer of the things and that the stockholders really want to see happen. The board of directors then elects, or I guess doesn't elect, they appoint a CEO or president of a company. From that point, then the CEO will have like a CFO, which is the chief financial officer. They could have different vice presidents. They could have a chief operating officer, a chief information officer. There's a lot of things that couldn't go underneath that CEO. On the CFO, chief financial officer side, it is broken down also into a treasurer as well as a controller, and these do have different functions. The controller's responsibilities are looking at maintaining the accounting records, ensuring an adequate system of internal control, preparing financial statements, tax returns, and internal reports, whereas the treasurer has the custody of the corporation's funds and is responsible for maintaining the company's cash position. So those are some of the things that we look at, and those are some of the accounting functions that you'll see, and then they'll have people underneath them as well, and it'll go on down the chart. When we look at manufacturing accounting, we're going to start looking at manufacturing companies. Up to this point, with Accounting 101, you studied service companies, and then you studied merchandising companies, those that were retail. In this one, we're looking at manufacturing companies. And a manufacturing company is a company that is producing an item to be sold. And their costs are going to be divided into two different types. You have a product cost, and then you would have a period cost. Now, with product cost, these are the costs that it takes to convert those raw materials into the finished good. And so they are going to include your direct material items, and your direct material is really looking at those raw materials. Those are the basic materials that are used in this manufacturing process. And the direct materials are those materials that are easily identifiable, and we can see that they go with this particular product. Then we have our direct labor. Direct labor are those costs associated with actually taking that raw material, that direct material, and converting it over into the finished good. And with direct labor, these people are actually physically doing the labor to convert and to finish this process. These would be people like your assembly line workers. The people that are actually working on the product would be direct labor. The third item is manufacturing overhead. And manufacturing overhead pretty much is anything that's not direct material and it's not direct labor that is related to manufacturing this product. It will include indirect material. Now, indirect material is going to be material that's not able to be directly traced to the finished good. Those could be items like glue and screws and things like that. That it's impractical to actually trace to the physical product, and so that would be indirect, and that would go under manufacturing overhead. Indirect labor is another item that we have out there. This is when we have like a supervisor that is over the assembly line workers. he's not actually touching the product and making the product. He's just supervising that the product is being made. And so that is a product cost, but it is an indirect labor cost. And that would fall underneath manufacturing overhead as well. Other things that you will see under manufacturing overhead are going to be rent for the factory building, supplies for the factory building, depreciation for the factory building. These are going to be items that go along with the factory. It deals with actually producing goods. So things that takes the utilities of the factory building. The plant manager's salary would also be part of this manufacturing overhead because it goes with the factory. Then we get to our period cost. And period costs are selling as well as administrative cost. These are your marketing expenses would fall under your selling expenses, and that is a product cost. Your sales commissions would be a selling expense. That is period cost. All these are period. Selling and administrative are period cost. Administrative costs are things that deal with the office. So if you are paying rent on an office building, that is going to be an administrative cost. Utilities, depreciation on office equipment, all of that is going to be an administrative cost and would therefore be a period cost because these are not dealing with the actual production of the product. Remember, product costs are dealing with the production of the product. Selling expenses is dealing with selling the product, not producing the product. So it's a period cost. And those administrative expenses are also period cost. In a manufacturing environment, we actually have 3 inventories. In merchandising, we only had that one inventory. But now that we're in manufacturing, we actually will have 3 inventories. We have our material inventory. We have our work in process, or it could be called work in progress inventory. And we have our finished goods inventory. One of the things that I want you to be able to do, and it will help you greatly with all of this, is being able to come up with this diagram that I have for you. You really should have this memorized and be able to produce this so that you can work all of these problems. What I'm looking at right now is going to be the cost flow and how it works with these different inventories. So we start out and we make a purchase of material from a supplier. So we have our materials inventory and it is sitting in a warehouse. And so we have beginning inventory in there. We make purchases and that comes into the warehouse. As these items are requisitioned out into the factory, they would be direct materials used, and they are actually going to be moving from the warehouse over into the factory. What we have left over at the end of the month would be our ending inventory. Now, in the actual factory, we have what we started with because nothing's finished on at the end of the month. We still have stuff there. So we have what we start with at the beginning of the month. We add to that our direct materials that were requisitioned out of the warehouse. We also add to that direct labor, and we add to that our overhead cost. Now, these costs are what we call total manufacturing costs. So if you take and add these 3 things together, you will get the total manufacturing cost. Then, when we're left at the end of the month, throughout the month, we've been taking and sending things over. What we send over to the warehouse are those goods that we have finished. And those goods that we have finished in the factory are called cost of goods manufactured because we have now finished manufacturing them. We move them over to that finished goods warehouse. And so we start out with what we have in our finished goods warehouse. We add to that as we finish it during the month. And then as we sell items, that is our cost of goods sold. And so you'll see I'll have like on the way to your retail establishment or your wholesale establishment to then be sold by someone else, and that would be part of our cost of goods sold. Hopefully you will notice that each of these start with our beginning inventory and end with our ending inventory in these particular boxes. Anything that is coming into a box would be added. Anything that is leaving a box would be subtracted, and that's the same thing that we see here. So you notice that direct materials is subtracted here and it's added over here. Cost of goods manufactured is subtracted here and it's added over here. So if it leaves one side, if it is coming into a box, it would be added. If it's going out of a box, it would be subtracted. And so that's one way to look at it. But I would go through this diagram, make sure you understand this cost flow and how it works, because these will also help you with your different equations. And you do have to know these equations. And yes, memorize these equations. So if you learn the boxes, you can then see how these work. Because if you look in box 1, it starts with beginning inventory. You add your purchases, you subtract your direct material used, and that gives you your ending materials inventory. Now you can change this equation with a little bit of algebra, and what it changes to is that direct materials used equals your beginning materials inventory plus your purchases minus your ending materials inventory. Now the next box, box 2, deals with work in progress inventory. With this one we have a couple of equations that we want to look at. If you remember, I told you that if you took your direct materials used plus your direct labor plus your overhead, those items coming into box 2, they were going to equal total manufacturing cost. And so TMC equals your direct materials used plus your direct labor plus your overhead. And then we can come down to that second equation, which is beginning work in progress plus your total manufacturing cost minus your cost of goods manufactured equals your ending work in progress. And that can be changed to your cost of goods manufactured equals beginning work in process plus your total manufacturing cost minus your ending work in process. And then for box 3 equations, this deals with your finished goods. So we start with our beginning finished goods inventory. We add our cost of goods manufactured, subtract our cost of goods sold, and that will leave us with our ending finished goods inventory. Another way of writing this equation after we apply the algebra is cost of goods sold equals beginning finished goods inventory plus our cost of goods manufactured minus our ending finished goods inventory. Now we can use these equations and these boxes to then be able to do our statements. The first statement that you're going to have to be able to do is the cost of goods manufactured statement. Now with this statement, you will go back and you will look at box 2. So you notice box 2 starts with beginning inventory. And that is, what I'm looking at is right here. It starts with beginning inventory. Then we add direct materials to it. Well, where did that come from? It came from box 1. So when I come over and I look at this, I will start with box 2, beginning work in process, and I have that amount listed. Then I will go back to box 1 for my direct material. Well, box 1 starts with beginning direct materials inventory, so I put that amount in. I add all my purchases, and then I will get my material available. I get that by adding, because it says beginning direct materials and then add purchases. So I add those and get the sum. I then have that materials available. Less means what? Subtract. Ending materials inventory. And then my difference would go in a different column. Now you notice here, hopefully, that I have 3 different columns here. And I can have as many columns as I need. So I would sum all that, or find the difference, and the difference goes here. I then would put my direct labor in, and that's just a total number. For manufacturing overhead, you need to list all of those items in manufacturing overhead and total them up. So I would list all of my items out, I would add them up and put the sum over in that second column. Then if I add my direct material plus my direct labor plus my total for manufacturing overhead together, I will get the total manufacturing cost, and that sum is going to come over and be right underneath that beginning work in progress, because I need my beginning work in progress plus my total manufacturing cost. So I'm going to add those two items together and get my cost available. I then will subtract out my ending work in progress, and that the difference in those two items will give me my cost of goods manufactured. Now here, this difference should be double underlined, okay? So you want to have a dollar sign here, dollar sign up top. When I start a column, I need a dollar sign. So make sure that you have your dollar signs in the right place. Make sure you have all your underlines there. I tried to go through, and when you add things, I put sum. When you would subtract things, I put difference, so that you could see where all of these items are going. And so hopefully you'll be able to see, all of that information. But this is the cost of goods manufactured statement. Notice, started with box 2, inserted box 1 for direct material, then went back to box 2 to finish it out. Very, very similar. If you look here in box 2, you notice, I have to find cost of goods manufactured. I take my beginning work in progress, my total manufacturing cost, which was direct materials used, direct labor and overhead, and then less that ending work in process. So these boxes will help you with the process. The other statement that you have to know how to do is the cost of goods sold statement. This is very similar to what you did in Accounting 101 with a merchandising company. You had inventory, you added your purchases, you had cost of goods available for sale, less your ending inventory gave you your cost of goods sold. The difference here is that we are going to be adding that cost of goods manufactured. Now, where does that come from? Well, that's coming from the cost of goods manufactured statement. So that's where you want to find that information. So again, beginning finished goods inventory, add your cost of goods manufactured. That gives you your cost of goods available for sale, if you add those two together, less your ending finished goods inventory, and the difference of those two would give you your cost of goods sold. Again, dollar sign to begin, dollar sign to end, double underline when you finished with your statement. And the last part here is this balance sheet. Remember, balance sheets for current assets, and this is the current asset section, are going to be listed in the order of liquidity. Now, what is the first thing that's going to turn into cash? Those finished goods. They're ready to be sold. Work in progress still has to move up to finished goods before it can be sold. So the order of liquidity would be finished goods, then your work in process, then your direct materials. You're starting a column, so you would have a dollar sign. And then all you're doing is you're adding all these up and you're summing those and moving that total over to add up with the rest of your current assets. So that is what you're looking at as far as the balance sheet is concerned. And that pretty much does it for this particular chapter. We will start looking at in a little bit more detail and look at some job costing versus process costing, but you really have to know this material. You have to know what a product cost is. You have to know what period costs are. You have to know if it is a product cost, is it direct material, direct labor, or is it overhead? You will have a quiz on those pieces of information because those are vital for you to know moving forward. One of the other things that I want you to go ahead and realize here, we have two different costs. We have prime cost. Prime cost are those costs that are direct. So if it's a direct cost, and that would be direct materials and direct labor, are prime cost. The other thing that we have is conversion cost. And I'm going ahead and letting you know about all of this ahead of time, because we are going to be using this terminology. Now, your conversion cost is any cost that it takes to convert. Alright, so any cost it takes to convert the raw material into the finished product. So, these items, direct labor, that's something we use to convert that raw material, to convert that direct material into the finished good. And the other item there is going to be your overhead. Now, I want you to realize that overhead can be spoke of and seen different ways. Overhead can just be abbreviated as an OH. It could be FOH, which is factory overhead, or it can be MOH, manufacturing overhead. These all mean the same thing. So don't get confused if you see, this terminology used a little bit differently. They all mean the same thing. So it's overhead, factory overhead, manufacturing overhead. Overhead can be called any of these items. So I just want you to realize that so that you have that information. So again, make sure you work any worksheets that I have out there for you so that you can understand this material before you get to those tests or those quizzes.